Now, a lot has been said about the global equity rally and expensive asset prices to the extent that some have already called a bubble in financial markets. But renowned investor Jeremy Grantham seems to believe that the bubble is not large enough to burst, well, at least not yet. In his latest article, Bracing Yourself for a Possible Near-Term Melt-Up, Grantham writes that financial markets are in the melting up phase and that a meltdown is some time away. Well, what's the difference between a melt-up and a meltdown? Niraj has that explanation and some charts to report on. Niraj.
Yeah, thanks, guys. So, starting off that this is more on the US markets that he's written and not necessarily the world markets by and large. But because it's the mother market, any melt up or melt down could well have an impact there. But what I thought I'll start off with is what stood out for me as the most telling line or piece out of that whole long 12-page note that Jeremy Grantham has written. And he mentions that even in the case of a bubble territory, if you call a bubble too early and get out of your investments, it could be as painful as staying put with the investment and then seeing the investment slide after the bubble has burst. And which is why I think this line that being late has not been too different than being too early. Being little early is okay, but being too early is a problem point. Now let me get you those four charts which exhibit what could happen. Now these are four bubbles that Jeremy has pointed out: the 1929 S&P 500 bubble, the 1989 Japanese equity bubble, the S&P 500 tech bubble, which a lot of people would be aware of, and then the recent one as well, which is the housing bubble. But in all of those, the time frame between point to point, wherein what people argue as the bubble territory started and when it came down to, is about 3.5 years. So say you call the bubble at this point in any of those cycles, wherein you might have been too early, you may have identified it well, but just in terms of the market behavior, you are too early in calling it a bubble and therefore getting out of it. You miss this whole rally, and even though the downside has been swift, the pain that you would get when you see other asset managers and other investors profiting while you are not, and your portfolio is standing still because you're sitting on cash, is very, very painful. That's the point I think Jeremy is trying to make. And in each of these bubbles, it's a very interesting coincidence that the time frame between the point of calling the bubble and when the market traces back to that same level is about 3.5 years. So it's a fairly long time frame, and we've seen this enough number of times in the past as well. I think 2008, when the meltdown started, a lot of people had called that, oh, we're seeming to be in bubble territory from 2006 onwards. And there were a clutch of others who were laughing all the way to the bank in 2007. Now, who eventually got out at the right time is a debate that we can have till the cows come home. But this is a very interesting piece of thought that Jeremy left us with, and I thought we should highlight this in particular. And of course, he doesn't say that we are in bubble territory as yet. I'll come to that chart in a bit. He doesn't say we are in bubble territories yet. But just this point, keep this in mind. Calling it too early might be as painful as staying put and then experiencing a slide downwards. Now, fast forward it to the current point of time and the S&P 500 chart over the last 3 years. This is the 3-year chart, and Jeremy makes the point that until about June, we seem to be, according to him, in a decent slide, but just that there has been a marked acceleration post-June, wherein we are at 2,700. And according to Jeremy Grantham's calculation, for the S&P 500 at least, he says, and I quote, that a level of 3,400 to 3,700 over the next 9 to 18 months would show a 60% gain, which essentially takes us into the past bubble territory percentage gains. The biggest one was 1929, which was 108%, but the other 2 or 3 bubbles had about a 60% move in the late surge. We are not there as yet. So if we indeed move up, according to him, if we indeed move up to 3,400 to 3,700 on the S&P 500, which is currently at 2,747, in the next 9 to 12 odd months, then the S&P 500, according to Jeremy, might be in bubble territory from where the possible meltdown can happen. And last but not the least, the indicators of bubble formation. I'll make this quick, but he's put it out 4 points. The first point, increasing concentration and unusual outperformance of low quality and beta. Many people, according to him, are fixated on winners, and then they start buying into low beta and low quality names, which is a classic sign of bubble formation. Other asset classes making equally bubbly moves. And he again quotes a reference to the US housing market, wherein he says that the prices have inched up. They don't seem to be in bubble territory as yet. So that is his caveat. But he says that housing markets are starting to inching up, but not bubble territory as yet. The most interesting chart that I thought, he said, okay, this is extreme expensiveness. The third point that he made, which was the right party in power, and which is, he's saying in the US markets, the Republicans being in power has typically led to this. Now, hey, I know you all of us will smile at this, but he's made references. Hoover was nice to bankers in 1929. Nixon was nice to the Chinese in 1973. George Bush
was nice to Cheney. I love that.
in 2001 and 2008. And Donald Trump, possibly nice to Russians. Good 2019.
When did Dick Cheney become the equivalent of the Chinese or the Russians? I would like to know.
This is, as I said, Jeremy Grantham's views. But he's saying that all of these have coincidences wherein there is a right wing in power and they've been nice to unusual blokes, if you will. And all of that has resulted in an eventual meltdown. So don't know if 2019 could be the same. And Donald Trump being nice to Russians could be the reason, the anecdotal evidence, which might actually tie all of this in together. So this I thought was fairly interesting. Just a last thing, takeaway from an emerging market perspective. Viewers would be pleased to hear this, but Jeremy Grantham says that how to combat this bubble formation, if you will, from a US investor's perspective, go and buy emerging markets. He believes there's pockets of value there. So emerging markets is probably the place to be in.